Okay, there we go.
Perfect. All right. Hello, everyone. Welcome to another podcast, Uncable Group podcast with Jeevan from Capital Hungary. Welcome, my friend. Thank you for joining us again.
Thank you for having me here. I appreciate it.
Absolutely. This is our third collaborative effort since we launched. Jeevan always helps bring some input to the markets from both a fundamental and a technical perspective. Our previous sessions in the past years, we've talked a lot about central banks. We've talked a lot about central bank decisions and how they will unfold and its effect on the US stock market, the Forex, and I'm happy to say we've all played out accordingly in the from what we have previously discussed. Now, we are now currently in a market where we have a lot of central bank decisions. We have a lot of interest rate hike. Wait, let me unmute myself. Unmute. Okay. We can hear you now perfectly.
Yeah.
All right. I was saying now we are trading in a market where we have a lot of fundamentals going on, a lot of uncertainty, a lot of global turmoil going on in the markets, and we're seeing a lot of central bank decisions going on as a result from the COVID pandemic that happened last year, and a lot of mistakes that the central banks have made. I would first like to start off, which is, I believe, the most important subject. I would like to start off by talking a little bit about the Federal Reserve and its decision to aggressively increase interest rates, and how is that affecting the dollar, and how is it affecting US equities, and how should we as traders be looking at that, and what should we be paying attention to? We can start off with that and take it from there.
Okay. So from my perspective, basically the best way to describe this is to go through the timeline of events that took place ever since the pandemic first hit the world. And we can use the Federal Reserve and US economy as an example, but main global powers followed a very similar pattern when you're looking at other central banks as well. But because the US dollar is your world reserve currency and business currency, the actions taken by the Federal Reserve were far more aggressive and had a far deeper impact. So we have to start from the beginning, March 2020, when the pandemic really hit the scene. And we have to understand something, that it wasn't the virus itself or the pandemic that led to economies being stagnant and economic activity dropping. It was governments making the decision alongside central banks to put in these policies of lockdowns, where these lockdowns completely shut down the economy, right? So then alongside human greed, this creates another crisis, which we see repeat in history time and time again. So March 2020, like Subi is showing here on the chart, you can see we had an initial spike up on the US dollar there to peak yearly highs around March 2020 period. And then what we had take place is, because now a crisis has occurred, very similar to the global financial crisis of 2008 or other previous historical crises, the government and Federal Reserve jump in to start supporting the economy and helping this crisis. The way they do that is by exponentially increasing the money supply and also keeping interest rates low down to zero. This is why you could see what Sylvie's going to be labeling out here is, from that March 2020 period, we saw the dollar devalue very aggressively for about a good year and a half, up until almost May, end of May 2021 there, right? The reason for this is basic economics of supply and demand. When you have a very high supply of something, a good, commodity, currency and very low demand, you have a decrease in the value of that, whatever it may be, in this situation being the dollar and currency there. So go ahead. Yeah, do you want to jump in?
Yeah, so absolutely. So we saw that it's almost the repeat of the same pattern that has happened in previous economic crisis, where we saw the Federal Reserve keeping interest rate low, the money supply increasing, and then what I'm more interested in is then what happens in the after the fact, after where the Federal Reserve realizes it has backed itself into a corner, and then the dollar has been devaluing for a while afterwards.
But it's not, in my opinion, this is what I'm trying to explain. They didn't back themselves into a corner. Everything they did was very precisely planned because of human greed and them setting up a fire sale in commodities, equities, and housing. Because the pandemic led to a downside move when it initially came up in commodities. Oil went to negative $40 a barrel. The stock market crashed and went to fire sale prices. Housing at that time initially dipped and went cheaper as well, right? So it wasn't like they were backing themselves into a corner. Everything they were doing was very well planned. They were willing to sacrifice devaluing the US dollar in the short term to have an increase in money supply and an increase in inflation, because then when they increased the money supply and kept interest rates so low, this is what makes it so favorable to be buying into the stock market from those lows, or buying into gold from lows, or commodities like oil from lows, because you have low prices, low interest rates, and support from the central bank through their asset purchase program, quantitative easing, and so forth, and them pumping up the markets. So it's a cycle of repeating human greed in history, where we have to understand something about inflation. The definition of inflation is that it inflates the price of everything within an economy, right?
Yes.
So inflation, to an extent, before you start to reach hyperinflation levels, is beneficial for the ultra rich and wealthy, because inflation increases the price of their asset classes, of their homes, of their oil, of their business, of their gold, of their stock market holdings. Because we have to understand, majority of cash that the ultra rich, the ruling elite, the wealthy get, it goes back into investment and goes back into ownership of asset classes. But the majority of cash the working class, the middle class, the regular day-to-day citizen gets from their job, it goes into consumables, it goes into consumption. So inflation there, it does two things. You have it increase the cost of living for the working class, which is a negative, and all of their bills and their spending goes up the same time the dollar's devalued. But for the ultra rich and elite, that inflation on top of the asset purchase program, on top of the low prices, on top of the low interest rates, the inflation also inflates the price of all those various asset classes, right? So
100%.
it's not like, so it's not like they were backing themselves into a corner. It's just this, what we've seen in the stock market, going from that crash on S&P to 2,200 and a rally to almost 5,000. That is human greed displayed on a chart. You know what I mean?
100%. It went from all the way the dump that happened as soon as the COVID hit, and then all the way it created all-time highs until we started seeing a more aggressive hawkish tone from the Federal Reserve.
Exactly. So we have to understand something. During this period of 2020, and where you had this rally of almost 122%, the pandemic was still going on and impacting the working class and day-to-day person. So who's making all this money in the stock market? Who is making all that money with oil going up to $130 a barrel from negative 40?
Yes.
Who's making all this money behind the scenes as the world and working class is suffering, right? Same date. Look at March 2020 on oil. Same date, same rally.
Exactly. From all the way when it hit, it went into the negatives.
Exactly. And then you have, again, oil, low prices. You have fire sale, record historical low prices. You have interest rates low at that time. You have the US dollar increase in money supply and inflation going up. And then you have the asset purchase program of the central banks, which inflates the stock markets, energy sector, and everything in between. So while the world is suffering, the cycle continues to repeat of the central banks, government, and corporations working hand in hand to make billions and trillions of dollars in gains at the sacrifice and cost of the working class person, right? Absolutely. So now what we've seen and what I wanted to get into is now almost two and a half years later, after seeing such aggressive rally on stock markets, on housing in North America and Europe as well, on commodities like oil and gold, reaching either historical high price points or record high price points, what we have to understand is now the cycle in terms of the central bank monetary policy is starting to shift. The reason why it's starting to shift is because inflation now over the last 2.5 years has gotten out of hand. If human greed was not in play here, the Federal Reserve should have been raising interest rates as soon as the US was no longer in a lockdown.
Correct.
Right?
Correct. Because that would have been the logical thing to do. But
that would have been the by the books, the logical thing to do, right? But because of human greed and that hunger for more gains, more extension of wealth in stocks, in gold, in oil, and so forth, that wasn't the case. Because once the US was out of lockdown, they could talk about COVID as much as they want within the news and in the media, but there's nothing impacting economic data anymore. If the US is out of lockdown, what's going to cause any impact to jobs? What's going to cause any impact to industrial or manufacturing activity? Nothing. Everything's back open again. Everything is starting to surge. That's why if you look at some economic data points you could reference later as well, you would see that as soon as the US was out of lockdown, even though COVID was still rampant within the mainstream media, we were seeing huge surges in economic data. Because what you were having happen was going from a crash point of a turned off economy all the way into an overheating economy surging right after the lockdown, right?
Everything happened. So the economy opened up, companies opened up, the stimulus checks stopped at that point.
Yep.
to the US citizens, and everything was back to normal supposedly after the media stopped talking about the COVID pandemic, and not necessarily that the virus has stopped spreading, but companies have returned working. Everything.
The US was no longer in lockdown, right?
100%. Yeah.
So if the US is no longer in lockdown, what other catalyst is there that could be impacting economic activity?
So only at the current point, it was only everything was back up. So it was only inflation and what the central bank decisions they have taken at that point prior to that.
Exactly, right? So from an economic data standpoint, everything's back to normal, even surging because you're going from a crash point to opening up again, meaning things like retail sales. As soon as economies opened up, things like retail sales surged after the lockdown and consumer consumption surged after the lockdown, right? But that is the time when the Federal Reserve sort of started raising interest rates, decreasing assets off their balance sheet, stopped any increasing of money supply, but they kept going for another 2 years purely due to greed, right? So now the big problem is, and trying to go full circle and bring it back to the main point you're talking about, the big problem now is now they are raising interest rates into a weakening economy. Inflation is at extremely high, record high 40-year levels in the US. Cost of living is unaffordable for the working class and regular day-to-day citizen, right? Yeah. All of these various asset classes that we're looking at, such as stock market, gold, oil, housing, is at record high prices. It's no longer favorable to buy into. And at this time of very high prices, extremely high inflation, weakening GDP out of an overheating economy, an economy starting to decrease in their economic activity, now the Federal Reserve has no choice but to start raising interest rates. Otherwise, inflation can reach hyperinflation territory.
Yeah, that makes sense. And this is more what I meant by they are now forced to do it. Like, because otherwise, as you just said now, the US citizen. And by the way, guys, we're seeing inflation not only in the US, we're seeing global inflation across the board, but throughout the US as well. Now we're seeing that gas prices are through the roof. People are not, as Jeevan has said, are not able to afford, middle class people are not able to afford the day-to-day living. But right now, do you think with the Fed, as I have seen from FOMC meetings and from the headlines, they want to continue raising interest rates? Like, we don't see any slowing down with the hawkish tone from the Federal Reserve, correct?
Yeah.
And where would that leave the dollar, and where would that leave the market? And what is the possible downside at the end of the day or at the end of the year?
So basically, they have no choice but to continue their hawkish tone and normalize interest rates. For example, the Federal Reserve back to 2.5 and 3% is their normal range, right?
Yeah.
And they have no choice to do that because that's the only tool they have to combat inflation, right? So they're looking at two problems. Number one problem is if they don't do anything and inflation reaches hyperinflation territory, that would just destroy an economy in itself. And individuals who rewatch this can go back test countries like Zimbabwe, Venezuela in recent times, Germany post-war. Hyperinflation is like a depression catalyst in itself, worse than recession, right?
Yeah.
So they have to make a choice. Either we continue stimulating the market and don't let these asset classes go down in value and inflation goes through the roof and we reach hyperinflation territory where essentially the currency has no buying power and the cost of living and cost of goods is far too high for anybody in the economy to afford, or they start to do an aggressive rate hike cycle into a recessionary phase, which will combat and bring down inflation in the long term, but will also cause a bear market and will also cause a lot of decrease in market liquidity and will cause a lot of downside on the stock markets, downside in the housing market, downside in oil, and downside in oil and gold as well. And will keep the dollar extremely bullish because you keep having interest rates rise and US dollar as the world reserve currency. So to answer your question, if they continue this aggressive rate hike cycle, and what we've already been seeing for the last month is the market's pricing in more rate hikes to come. Hence, we're starting to see the inverse movement we saw in the last year. Now with the stock market at all-time high prices, central banks starting to raise interest rates and stop their asset purchase program, we're seeing that stock market's in a bearish market, gold is extremely bearish, commodities are bearish, and majority of asset classes that were so bullish because of low interest rates and low prices are starting to have a shift in that whole market sentiment. Absolutely.
Do you think we will see, obviously, if this continues, and I think the Federal Reserve will continue with interest rate hikes until they reach their goal 2 to 3%. Do you think we will see the US stock market revisit previous COVID highs before the COVID pandemic started?
Yeah, I could easily see the stock market having a bearish correction to pre-pandemic highs. And if you want to reference something in terms of looking at a correction, go back to 2008, but don't look at the 2008 crash. Look at, if you can go back that far, I'm sure, or go to like a US 30 chart or NASDAQ chart. It's all the same example.
Let's see.
Go to Owanda. Go to Owanda down there. Feed. Yeah. So go back to 2008.
Let's see. All right.
Yeah. So you'll see the 2008 crash, right? But then around the 2012 period there, you'll also see a bit of a bearish market there. That's at that time when the Federal Reserve started raising interest rates, tapering, and switching into a more of a hawkish tone. So you can see that the market does have that bear market for a period of weeks or months as the market adjusts to the interest rate hikes and so forth. But what I expect from the in recent times is exactly what you said, of this bearish market leading to a retest of pre-pandemic highs And then the market adjusts. Stock market is forever bullish long term. You understand that anyways,
Yeah,
right? So yeah.
Of course. But I have okay, to stay on the topic of interest rate hikes and all of that, but we know now as Forex traders, right? We know the correlations, for example, with the dollar and the other currencies, for example, with the euro, it's negative, right? And with the Federal Reserve constantly increasing interest rates, right? Pushing the dollar higher and higher and higher, and consequently, the euro going lower and lower and lower. Do you think the ECB will be forced to start raising interest rates as well as a result?
Yeah, there was an IMF meeting on April 21st with all the major central bankers, and they all are switching into a hawkish tone of needing to raise interest rates. But I see a couple of questions about talking about Russia and Ukraine. But what I want people to understand is these catalysts like COVID or Russia and Ukraine, these are scapegoats for the US to point fingers and push the blame on these catalysts. For example, everybody says oil was so bullish when the Ukraine war started. But I just want to stay on topic with Subi and show that it's not the Ukraine war. Go to the oil chart. It was the inflation, increasing of money printing, and low interest rates. For example, from the crash point, we actually went from -40 up to almost $90 a barrel. And then that last bullish weekly candle you can see in recent times, that's Russia and Ukraine tensions.
All right. I remember at the top, it was when the investors were pricing in the US sanctions, correct?
Yeah, but like from there, from $90 a barrel up, right?
Yeah. Okay.
Mark that off. That's Russia and Ukraine tensions. But from -$40 a barrel up to $90 a barrel is all of the central banking action. So you ask yourself, what's really holding more impact in these global markets? The Russia-Ukraine tensions is nothing new. We've seen that before in 2014 with the Donbass situation. A lot of these catalysts, they're just scapegoats for the central banks to point fingers and to cover up and hide the actions of government and central bank policies, right? Like COVID was a huge cover up so they could do this, they could do these money moves in the market and set up this fire sale price on oil, or set up that stock market dip and then have a huge rally for a period of 2 years, right? So any downside we've seen on the stock market is the market adjusting to interest rates raising and the market cycle starting to shift from that previous central banking period. Yes, of course, on the intraday timeframes, when you have active war tensions going on, it's going to have some market impact, but nowhere near the degree of the impact that central banking had. Right? And also look at now, Subi showing the Wall Street chart here, showing the equity markets. Yeah. Look at the gains from 19,000 all the way to 36,000. Yeah. Even when we had new variants of COVID being discovered, other countries going on lockdown, massive fear within the news around COVID and the hysteria around it, it didn't stop the market from continuing up. Why is that? It's because the central banking action, who are the true market makers working in hand with the government and corporations, they controlled the money supply. They controlled the asset purchase program. They kept interest rates low, and stock market had monstrous rallies even amidst huge fear.
Yeah, that makes sense, because the stock market was mostly responding to the central bank's decision more than anything else.
And to add on to that, majority of asset classes were responding to central bank decisions.
Yes, including, I don't want to like derail the conversation, but including crypto as well.
100%, but that's a different podcast we could do.
Yeah, absolutely. Yeah. I think crypto has proven to be not a hedge against inflation. It is just reacting off central bank decisions, the same as the stock market, the same as
everything denominated or traded against the dollar as the world reserve currency in correlation to the central banking decisions.
Yes, I think returning back to the stock market as well, we will see that revisit of previous COVID highs, and it might be coincidentally when the Federal Reserve reaches their target of 2 to 3%. interest rates before we see any further bullish momentum or a slowdown from a hawkish tone from the Federal Reserve. But I want to go back to one point, Jeevan, going back to the what we were talking about, to the correlations of the dollar and other currencies. And you said there is an IMF meeting happening soon where all central banks globally.
No, it happened already, April 21st.
All right.
Yeah. Just back check that whenever you want.
All right. So where central banks in general are switching to a hawkish tone, do you think if we are going to switch the conversation maybe to the euro or to the pound? Obviously, with the Bank of England, we've already seen some interest rate hikes, and we've already seen a hawkish tone from the BOE, not as aggressive as the Federal Reserve, but hawkish nonetheless. How would you, as a trader right now, how would you attack these pairs like the Euro USD, the Pound USD, knowing that now all central banks are hawkish, right? And they're all trying to combat the same problem.
So the beautiful thing about the US dollar is it is the global reserve business currency. Oil is still traded in US dollars for the most part. Majority of import and export globally is done in US dollars. So in currency pairs, the US dollar is always going to hold more strength. So we have to look at this, and we can use two examples. In a pair like Euro USD or GBP USD, even with hawkish Bank of England or hawkish ECB raising rates, of course, raising rates is bullish for the euro individually. Raising rates is bullish for GBP individually, right? Just like for any other central bank in the currency. But against the dollar, those moves will not be sustained and they will get faded out because the US dollar is still a global safe haven currency and global reserve currency, right? So as long as the Federal Reserve is still more hawkish, or at least consistently hawkish compared to the Bank of England, compared to the ECB, dollar strength is still going to dominate. And any short-term hawkish comments from Euro, ECB, or from Bank of England to GBP is only going to be very short-lived upside pullback phases on Euro USD as you continue the overall bearish structure. But this is how we can confirm this theory even more about US dollar strength domination compared to another type of safe haven currency. For example, we know that one of the most dovish central banks still is the Bank of Japan.
Yeah.
Right? They're keeping their interest rates low. They're devaluing the Japanese yen. They don't mind that, right? So now
they are net exporters as well.
Exactly, brother. You understand. Yes. So now what we can understand is now pairs like Euro JPY, GBP JPY on the higher time frame as the ECB and as the Bank of England becomes a lot more hawkish, has a lot of potential for some continued upside rallies on the higher time frame, right?
Yeah.
So when we're looking at pairs like EJ and you're looking at pairs like GJ, we can expect a lot more upside, playing that one-sided volatility of hawkish central bank and Bank of England, hawkish ECB, but a dovish Bank of Japan and Japanese yen overall holding a lot less weight globally compared to the US dollar. But when you're looking at dollar pairs like Euro USD and GBP USD, it doesn't really matter how hawkish the Bank of England or our Euro Central Bank is. Majority of those upside moves on GBP USD, our Euro USD are going to be pullbacks, very short-lived, as dollar dominates globally as the business currency.
Yeah, that makes a lot more sense. So instead of like trying to, it would be a lot more safer for as traders to be playing the dovish tone of the Bank of Japan and trading it, for example, against the pound or the euro, like pound yen or euro yen, and then playing
UJ.
Exactly, playing the weakness of the Japanese yen. And since switching to the Japanese yen a little bit, now we know the main reasons. Of course, now we're seeing a lot of weakness in the Japanese yen is because of the dovish tone of the Bank of Japan, and also them releasing statements that they are unwilling to change. They want to keep interest rates pretty low. They don't want to change the current monetary policies they have. And they also, I think it's a month back, they released an unlimited bond purchase program. Correct?
Yes, correct.
So let's talk a little bit about that.
Yeah, let's go to the JXY chart. And this is also great to add into the points that some individuals are saying about the Russia-Ukraine tensions, right?
Yeah.
So we know that the Japanese yen is a safe haven currency. During times of fear, uncertainty, and doubt, you should primarily see more liquidity coming into the Japanese yen for as investors hedge against the fear risks, correct?
Yeah.
So that means when Russia and Ukraine tensions were at play, or when the pandemic was extremely active, we should have saw the Japanese yen a lot more bullish. The reason why it's so bearish is because of central banking, like Subi is saying.
Yeah.
Bank of Japan's monetary policy of being so dovish, keeping interest rates in the negative, openly willing to say they're willing to devalue the yen to increase their international business and their unlimited bond buying program, that completely trumps and thwarts the geopolitical issues, and the central banking, you can see, holds a lot more weight. Hence, the Japanese yen has been so bearish.
Yeah, absolutely, exactly. And this is why we're also seeing it, and we're also seeing it a little bit debunking the a lot of beginner traders are thinking that the yen is a safe haven currency, but currently in these times, we're seeing those central bank decisions overcome that and keeping the Japanese yen with extreme bearish momentum, as we saw from a couple of pair, pound yen, euro yen, all of those.
Because we have to understand, to keep it simple, the central banks are basically the cartel of the currency. Just like you have OPEC, the oil cartel, you have you know what I mean? The central banks are basically, they control the lending rates down the line into the economy, the supply, the demand, essentially. So they have that power where as soon as they start to take action, whether it's in a dovish fashion or hawkish fashion, it's going to hold a lot more weight compared to geopolitical tensions going on, unless we have something like World War III pop off, right? Yeah.
Something not priced in. Something.
Yeah, exactly. New events.
New events. Speaking of new events and things being priced into the market, I want to switch the conversation a little bit to gold. All right. Now we've seen gold throughout the Russian-Ukraine tensions increase in value, and I wanted to ask you: do you think at this point, because I also want to bring back the pattern that we are witnessing,
we're gonna get that historical repetition.
Yeah,
for sure.
Do you think at this point the Russian-Ukraine tensions, with the current fundamentals, they are already priced into gold?
Yeah. So all of the sanctions, all of the weapon support of NATO countries sending Ukraine weapon support, all of the NATO threats and constant political disputes from a diplomatic perspective, all of that is priced in. The only way I see Ukraine and Russia tensions having further impact is if NATO countries, whether in Europe or the US as a major player, actually get involved in a physical front. If the US starts sending military to support Ukraine, if NATO countries actually start getting physically involved and pushing Putin from that perspective, then you will see Russia and Ukraine tensions hold a lot more market impact, because you have new events coming to the table that bring a lot more risk, uncertainty, and doubt. Because if NATO countries start to get involved from a physical front, then China starts to talk with Russia. India and Pakistan start to talk with Russia, and you have more of a global war start to develop and take place. This is the reason we've seen a lot of threats from the US, but no actual physical support for the Ukraine military at all.
Only economic sanctions.
Only economic sanctions, only sending weapons. All the money they made from the pandemic, now they're laundering it through Ukraine. Right?
Okay, yeah, that makes sense.
Yeah.
I also wanted to point out, we are almost witnessing the same pattern that has occurred previously over here when we have printed all-time highs on gold, right? We have moved sideways for a couple of months before we saw the breakdown to the downside. We are almost witnessing the same exact pattern here, where we have printed new all-time highs, and now we are moving for a couple of months to the sideways. We are having sideways price.
But go back to that period in time. So look at remember when I was showing you that bearish corrective market on the equities after 2008 and 2012, when the central bank started raising interest rates and turning a lot more hawkish. Look at the date on gold now, 2012, when it starts to turn more bearish. Right. So that just further validates, and what we're talking about debunking what actually impacts the market. The central banking is going to hold the most weight. In that 2012 period, a few years after the 2008 global financial crisis, when economies start to recover and could sustain the interest rate increases, the Federal Reserve started raising interest rates, tapering, and normalizing rates. And we saw the majority of asset classes bearish at that time. Stock market had a correction, gold had a correction, oil was a bit more bearish during these interest rate hikes, with the dollar a lot more bullish. So we're getting the same technical repetition and historical repetition, but also the same fundamental repetition of what the central bank is doing in terms of their monetary policy.
Yes, both from a technical and fundamental perspective, we're seeing that pattern replay and play out again. Jiva, I know you have a very strong fundamental background, but I also wanted to get a little bit touch on something different. I wanted to touch on something technical, maybe a little bit with you in regards to interest rate decisions and having fundamental events being priced into the markets, right? Now we are seeing, with the constant hawkish tone of the Federal Reserve, we're seeing constant bullish momentum on the dollar. However, on the day of the interest rate decision, at the time where it comes out, we see the exact opposite effect. And that is not only, guys, regarding interest rate decisions, but anything that is already priced into the markets, and then the news or the fundamentals come out at that time. We see the complete opposite effect. Have you ever heard that Wall Street saying, buy the rumor, sell the news?
Yes. That is exactly what that describes and what the pricing in concept is. So the market, because it's based on human psychology and greed, everybody, especially now where everything's algorithmic based and it's all machine based supercomputer trading, everybody's trying to get an edge on each other. So the market is always moving on anticipation. The central bank giving rumors of interest rate hikes to come before the actual rate decision, you already have the markets adjusting and starting to price it in, right?
Exactly.
So then at the actual rate decision, when it's just as expected, you have that buy the rumor, sell the news, where it's going to have more of an inverse impact, where really it's just setting up order flow, creating that dip to collect more buy orders and still continue with the overall macro sentiment in play, which is the hawkish tone.
Yeah, I'm trying to remember when was the exact date we had the last.
You had a circle right there, that pullback, that bearish pull. Yeah, right there.
Yeah, all right.
That was it.
Yeah. So we see here, we had the interest rate decision. It was increased, I believe, was it 50 basis points?
50 basis points. But,
yes,
but
it was already priced in.
We were getting rumors about 50 basis point rate hikes to come weeks prior. Hence, that such an aggressive bullish rally that first couple of weeks from April all the way into May. That whole month, ever since the rumors the central bank started giving about raising interest rates, you started to see that adjustment, because the central bankers themselves say this. You can find statements from various central bankers, Jerome Powell himself. They know how much power and how much control they have over the markets and how much influence they have. So they have to be very smooth and steady with how they give out information, so they can give the market time to adjust to it. For example, if they don't give these rumors of interest rate hikes to come, nobody knows rate hikes are coming. And then all of a sudden at the rate decision, they do a 50 basis point rate hike when everybody's expecting no rate hike. It's going to cause detrimental impact on the markets, on the stock markets and so forth. And these greedy 1%ers and ruling elite, they don't want to cause a big meltdown on their stock market unless it's a planned crisis for opportunity. You know what I mean? Once their positions are in, they want to keep that greed train chugging as long as they can.
Absolutely, absolutely. So if it weren't, we didn't hear headlines and we didn't see from all the FOMC meetings that they were going to actually increase interest rates, then if they do it unannounced, then we will see a huge drop in the stock market and the dollar rising consequently as well. What we have
a
here,
big shock.
Yeah, what we have here previously, we see the dollar slowly increasing, and it is increasing in anticipation of the Fed following through and actually raising interest rates.
Exactly.
Right?
Yeah.
And we should also now, by looking at, because we're going to have further interest rate decisions come in, and we're going to see this pattern playing out multiple times. So I just want to repeat this. So now when we are going, let's say, the further next interest rate decision, we're having the same fundamentals where we have the continuous hawkish tone of the Federal Reserve, and we're expecting, for example, another 50 or 25 basis point rate hike. If we get a higher than anticipated rate hike, then we should continue to expect bullish momentum on the
just straight bullish momentum. Yes, because it would still be a surprise that they're even more hawkish than they've been hinting at.
Exactly. And if we do get the same, then we should expect this sort of pattern, the correction.
Exactly. I'll buy the rumor, sell the news, where you have a short-lived, and even this buy the rumor, sell the news. I expected this pullback to even go a bit deeper, down to 100.5 at the time. Even have
we did as well. We were trading it live, and
it was so short-lived.
Yes.
Yeah.
If you look at it, is more noticeable if we look at the actual pairs. I think it was US 30 that we were trading, and the wick, it was just like a lower wick to the downside before the bullish momentum happened.
Yeah, that was it right there.
Around here, this one.
Yeah, that was exactly it.
Yes, it was this one. I remember it. Yeah.
And something else I wanted to throw in is as we're looking at the stock market, in this bearish market we're going to see in the stock market, expect a lot of dead cat bounces. You know what I mean? Because you're gonna have
bounces, meaning
like a lot of these bounces that occur with buyers trying to grab the dip and then liquidating positions from better price points. Expect a lot of these, like they're called dead cat bounces, that occur, where it almost fools that a dip in bottoms being created to pull in more liquidity, but you just have the institutions liquidating from better price points. The bearish market in the stock market is always far more corrective, far messier compared to the greedy bulls in play, which is just, you know what I mean? It makes sense psychologically when you're thinking about market psychology, right?
Absolutely. No, we have been witnessing that, especially with the US indices. We're seeing those slight retracements before the continuation in the overall bearish momentum. For a while before that, we had some sort of retracements, stronger retracements over here. I was talking about more of this on US equities before we had the continuation with the bearish momentum. But I think it was just greed from investors trying to get as much bullish momentum as possible before the drop.
Yeah, and also to push prices up to more favorable liquidation points.
Yeah, that,
you know what I mean?
Makes sense. Yusuf saying crushing the middle class and more control as a result.
Yes. Always. Yeah. Every time.
All right. This is basically, so now heading forward, we can obviously continue to expect the same fundamentals to play out as long as no sudden headlines change. In terms of safe haven currencies like gold and the dollar, the only thing that we can expect that is not already priced into the market is, as you said, if we see NATO intervention. Is that correct? Or something that is, and that would push gold and safe haven assets to the upside. Sorry for cutting you off. Continue.
No worries. The only thing with the gold is, because gold is still a bit of a different asset class than currencies, it's a precious metal used in industry, the mining, the supply, the demand is a heavy impacting factor on it. It's still going to primarily be following the interest rates and continuing bear. I think the only thing that's going to really be bullish, as long as we don't have any new geopolitical tensions with Russia and Ukraine, is dollar. Really. You know what I
But
mean?
even if we do, it would stable if we have new acting as a safe haven, no?
Yeah. But
Yeah.
but if we have new Russia and Ukraine tensions like you're talking about, that would give some short-term bulls to gold, or at least bring some demand back to gold to hedge against the risk. You know what I mean? But other than that, if we don't get any new fear catalysts, whether it be maybe COVID makes a return and countries go back, who knows what could happen, right? We've
Yeah.
seen a lot of crazy stuff the last 3 years, right?
Absolutely.
So we could see COVID make a return and maybe lockdowns come back, or if Russia tensions escalate to a point where other major powers get involved from a physical military front, then I could see currencies like Japanese yen or like as a safe haven, or gold picking up a little bit more demand on the intraday timeframes. But other than that, this, like you've been talking about and highlighting and also debunking yourself, central banking is dominating because they're the rulers, right? They're really the rulers alongside the governments, of course, working hand in hand. And it's the corruption goes down the line there, right?
Absolutely.
Everybody's trying to grab their piece at the cost of the middle class and working class, repeating through history.
Absolutely, and we've been seeing that over and over again. And speaking of the COVID pandemic, did you realize that paper that the judge ordered from Pfizer, where it released the 1,000+ side effects of the vaccines, disappeared off the internet? I don't think you can find it anymore.
That's crazy, eh?
And news media outlets have stopped talking about it. And COVID, as soon as Putin hit Ukraine, has suddenly disappeared.
Just go from one catalyst to the next to have scapegoats and blame, but they're doing all the money moves behind the scenes while the world's panicking.
Let's see, we have the old system of FX reserves held primarily in USD is dying, maybe. A replacement is needed, maybe. Putin now asking for different payment terms and conditions for his gas.
I understand that. I know a lot of talk about the Chinese yuan one day becoming the world reserve currency, but we have to understand it's a good point you're bringing up. But what we've seen happen with these Russia and Ukraine tensions, Putin wanting to sell oil in a different currency, the sanctions, the tensions, it's happened before in 2014, 2015, 2016. This isn't the first time Russia has invaded Ukraine, right? It's a lot of similar repeating impacts. And now to further add on to that point, you have to think a little bit more logically of how much global infrastructure is built on or depends on the US dollar, right? So it's not something that you can just change in a very short period of time or is a very smooth transition, because we have to look at the markets just past what we trade and what we invest in, right? The huge interconnection with global oil, the jobs created, traded in US dollar, international import and export, countries built on the US dollar and so forth, all of the international business done denominated in the US dollar, and the weight it holds, the infrastructure built on it is way too far, way too vast and deep. If we were to have the dollar collapse as the world reserve currency, that'd be a global economic collapse in itself. And we have a lot bigger problems than what the next currency is going to be. You know what I mean?
Yeah, absolutely.
Exactly, Yusuf.
It's not easy to replace USD. Most countries have USD dominated assets, bonds, treasuries, etc. And it's not possible to liquidate those without destroying the global economy. China certainly can't do this in the near term. Yeah,
100%.
That makes sense.
In China, like they can have these threats against the US and so forth, but as big of a powerhouse China is, China's biggest consumer is the US, right? They're like they don't want to get rid of that customer either. Yes, they have these disputes, Russia, China, and the US and so forth. It's been going on since the 40s and 50s, since the Soviet Union days with the big red machine and always having China as the enemy. But it's like a love and hate relationship where they make a lot of money with each other and also using each other to a certain degree as well, right? China wouldn't be as big and powerful without the consumption from the US, right? It was a big contributing factor to their growth, to their huge amount of money and income coming in. So it's not like China wants to really destroy the US dollar itself. They just want to have full control over the US economy, which which China has been doing to a lot of countries in the African regions, in the Asian regions, even Canada and Australia, is they're not taking over from a physical front, they're taking over in an economic ownership front.
Yeah, that makes sense 100%. And they, like you said, it is more of a love-hate relationship where they are using each other to make as much money as possible.
It really is, right?
Yeah, absolutely.
They're all corrupt to the same degree at the end of the day. It's all, yeah, they're all, yeah.
We're just here to take our piece.
Exactly.
Yeah. So now moving forward, just so I can summarize the topics that we have just went through real quick. We have talked about the Federal Reserve, the central banks, and how they will continue to combat inflation to possibly have a hawkish tone and increase interest rate hikes throughout the near future. The US dollar, being the world's reserve currency, being a safe haven, will overall dominate its strength over other currencies. However, if you are trying to pick a pair that you don't want to necessarily trade strong versus strong or bullish versus bullish, you could possibly be looking at the Japanese yen, where they are benefiting from a bearish yen due to them being a net exporter. And the main reason goes back to them having a dovish tone from the central bank. Yes, Jay. Yeah.
And like Bank of Japan's monetary policy was just like a week ago where they still kept it. I just want to add that on. Quick, but they still kept it dovish, you know, for the time being.
Absolutely. And then we talked a little bit about how price action reacts on events and fundamentals and headlines that are already priced into the market, where Jeevan said, buy the rumor, sell the news, correct? Where
that Wall Street say comes from, where that's all really market psychology, the pricing in concept, right?
Absolutely. Where we see, for example, with interest rate decisions, we see, for example, the dollar running with bullish momentum prior to the interest rate decision coming out. And then on the interest rate decision day, we see the correction to the downside before the overall continuation, the bullish momentum, because overall the Federal Reserve is still hawkish, right? And then we talked a little bit about how the negative correlations between the dollar and other currencies, right, like the euro and the pound and all of that stuff. And we still said that the dollar will hold still higher strength, if that is a correct term to say, over the other currencies, because it is the world's reserve currency and it is also a safe haven currency, right? And then we a little bit discussed about the Ukraine and Russian war and its effect to gold, and we are saying that that is already priced into the market. The only thing that we would see currently that would bring a little bit more of a bullish momentum to gold, if we were to see some NATO interventions between Russia and Ukraine, right, where it would bring something that is unexpected to the current situation. New events to the current situation. And that is basically the topics that I wanted to go through today, because I think everything is based around that right now. And if you are intraday trading, scalping, or even swing trading, these are the main points that you should be focusing on: the central bank decisions and what do we have for the next interest rate decision? What do we have as a tone, as a hawkish tone, as a dovish tone? What kind of headlines are being released? Am I correct?
Yeah, correct. Yeah,
basically.
Yeah. Mainly the central banking tone with a side focus on any of the geopolitical tensions. Like, keep an eye if Russia, Ukraine does start to heat up again. Last week, Brexit tensions are coming back to the table again for the 7th year. You know what I mean? So stuff like that.
Yeah. Absolutely. I wanted to just touch on one last topic before we end this, and it is completely out of topic of what we've been talking about in terms of fundamentals and technicals. I want to talk about a little bit about your experience with, for example, losing streaks, right? Or when you go through, for example, a downfall or maybe a retracement in your overall trading career, right? And how do you reset yourself psychologically? And what's the type of process that you go through just to see, okay, this is where I went wrong, this is where I have to change, obviously accepting where you made mistakes, or sometimes maybe you have to accept that maybe this is the current cycle of the market, because as we know, the market cycles changes, and maybe you have to adapt
accordingly.
Your trading style or your trading system, etc.
So for me, I'd have to start from the beginning. Basically, I've been trading for about 5, almost 6 years now. My first 2 years was complete retardation failure. Probably lost $50,000 total in the markets, constantly depositing, losing, introduced to the markets through social media. And the reason why I want to discuss that is because a lot of people who come into trading in the modern age are introduced through social media, where people do not show losses or the reality of trading. So you think that losses are not normal and that everybody should be becoming a millionaire in a very short period of time, saying, where's my Lambo, right?
Yes.
So I had to go through that 2 years of trial and error and really realizing the true ins and outs of the market, that this isn't really even a game of always being right or winning. It's a game of risk management and probabilities to be truly profitable, right? So instead of at the beginning, I was always trying to focus on having a high win rate, 80%, 90% win rate, trying to go on a win streak. And what this does is, yes, you can go on a win streak here and there, but really because of human psychology and how the market almost attacks human inefficiencies and weaknesses from an emotional and psychological perspective, hence why 90% of retail traders proven statistically lose. You cannot sustain always trying to be perfect, always trying to go for a high win rate. And it's not really truly profitable, as majority of people who can be on a win streak, as soon as they face a loss, they cannot emotionally handle that loss. They begin over leveraging, over trading, and completely blowing out any money they made from the win streak. So then I started to focus more on the mathematics side of the game and understand that winning trading is truly probabilities. You can be an extremely profitable trader, as you've seen with me now for a couple of years, being far more consistent and having more and more growth with a 50% win rate, but a positive risk to reward ratio being your focus, right? So for me, I understand that this is a game of probabilities, and I don't put pressure on myself to have a high win rate. I put pressure on myself to focus on following my trading plan and focusing that any trade I enter into the market has a minimum of a 1-to-3 risk versus reward ratio as my plan. Of course, sometimes you have to trade manage, close break even, maybe you take profits early, accept a minor loss. But my plan before entering any trade in the market is not to be a huge win streak. It's to make sure the risk I'm putting into the market based on my technical and fundamental analysis can at least net me a 1-to-3 reward. Because when you go with a 1-to-3 risk versus reward ratio or higher, you can do this very simply for scalping and day trading. This allows you to have a 50% win rate, winning 5 out of 10 trades in a streak, and still be very, very profitable, right? So let's think about it. Let's think about that you're risking $10 to make $30, right? And you take a streak of 10 trades, okay? You take a streak of 10 trades. If you lose 5 of those trades, you lose $10 at a time, you lose $50. But if you win 5 of those trades, you win $30 at a time, you make $150. Minus your expense, your losses from your wins, you net profit $100. You just made $100, even though you only won 5 out of 10 trades. That should be the focus for us as manual retail traders, not trying to put so much pressure on ourselves to be a perfect trader or to have a very high unsustainable win rate of 80 or 90% plus, right? The focus should be on the risk management and understanding the probabilities of risk versus reward ratios and how the benefit of that and how beneficial for that is for us. So now, coming full circle to your point, the way I'm able to handle losses and cope with losses and not let it get me down is understanding that basic math. I know that if I'm going to take a stretch of 10 trades in a month, if I lose 5, that's perfectly acceptable as long as I'm sticking to my trading plan and risk versus reward ratio, because the majority of my wins are triple the size of my losses. And at the end of the day, I'm going to have a net profit. Let me give you guys some good real world examples. When you look at a business, for example, a brick and mortar shop that may be selling some goods, they're not just making 100% profit and 100% revenue. They have their business expenses, they have their costs of operation, and then they have the revenue that they make from whatever product that they're selling. At the end of the month, you take your revenue, you minus out your expenses and costs, and then that is your net profit. For us as traders, losing and taking losses is inevitable. For us, it's like an expense. It's something that's a part of the game, something that you have to understand is very normal. But the whole point of our game, the whole point of a business is to have less expenses and more revenue coming in, and you're still going to be profitable at the end of the day. Another great example is back in the 60s and 70s on Wall Street, when you had manual traders at the desk trading, and even into the 80s and 90s before it became very algorithmic, Wall Street manual traders were very, very profitable, but they had a strike and win rate of 52%, meaning they would roughly win 5 out of 10 trades in a stretch. But the reason they were so profitable is because their risk versus reward in what they were putting into the market would be a 1 to 5, 1 to 10, 1 to 15, right? So their wins would be 5 times, 10 times, 15 times the size of their losses. And then at the end of the week, end of the month, you take away your losses minus take away from your wins, and you have that net profit, right? So keeping that focus of realistic expectations, the probabilities of the game, focusing on that risk management and understanding losses are inevitable, losses are normal, and it's an expense of being a trader or an investor, and focusing on positive risk versus reward, that's what helps me cope whenever I take a loss. If I put a risk into the market and understand that this has 100% chance of losing or winning, but based on my analysis, I see a higher probability of winning, and I set a pre-planned stop loss and a pre-planned take profit, as long as I hit my pre-planned stop loss at that 1 to 3 risk versus reward, that is an expense. Now, the issue with a lot of traders is they cannot accept that loss going to their pre-planned stop loss. They start to move their stop loss. They start to double down and add more positions. They remove their stop loss. Now you're completely going against risk management. Now you're completely flipping the risk versus reward. Now you're completely going backwards, right? But the way I visualize your trading journey is you're going to be taking a few steps forward, then a couple of steps back. A couple of steps forward, 1 step back. Maybe you're going to sprint forward for a little bit, then take a couple steps back. But it's not just a straight path to success, right? It's never like that. In business, in trading, in any industry, you're rarely going to ever have a straight path to success. You're going to go through these trials and tribulations. It's very normal, right?
I agree with you on the probabilities and the mathematical side of it, and that is at the end of the day, that's what keeps you calm when you're trading, because you know the mathematical probability is in your favor. What do you see to now? That is, of course, that only applies if you have discipline, and that is what I wanted to touch on as well. What do you think? Because we have a lot of people that come in that's quote unquote scalpers or day traders, but then they're trading every day, and then there is some sort of the feeling of the same as like when people go to a casino or whatever, you know, the feeling of gambling, the feeling of putting money and then waiting for that return. And I think a lot of people get addicted to that feeling, especially when they're scalping, and then in return, like, okay, I'm sticking to my stop loss, I'm sticking to my RR, but they're taking 5-6 trades a day, you know. And that is also something that I feel like you have to, as well as having the mathematical probability on your side, but also picking and choosing your battles, picking and choosing your opportunities. You know?
The sad and harsh truth about that is those same individuals sadly lack discipline in their day-to-day life. What I like to explain to anybody that watches my videos or I talk to from an emotional perspective is there's nothing in our life that impacts our emotions more than money or our loved ones, our family, our loved ones, and so forth. Because money is ingrained into this financial, global, social, political system, everything we do essentially in our life from an age of 5+, as soon as you're in school, you have to go through college, you have to get a job, you have to pay bills. Everything is tied to money. Majority of people's stress and issues, family problems comes from money, right? So we have to understand that our emotions are naturally already heavily tied to money. When you come into trading, the same emotional behavior that you exert in your day-to-day life is going to be amplified times 10 in trading. If you're very impatient or you're very angry just sitting in traffic while you're trying to commute to work and you're honking at cars, how are you going to handle losing money in the markets? You know what I mean? Everything in terms of emotional behavior in your day-to-day life will translate into your trading life times 10. The greed, the lack of discipline, the lack of emotional control, the lack of your own, the aggressive behavior, the anger, the impatience, it will be amplified. It will be exposed even more when you're trading the financial markets because you're literally putting money on the line for a potential reward. So the cold, harsh truth is, if people are lacking discipline and they overtrade while they're trading, or they can't follow their trading plan, at the end of the day, they're just undisciplined in their day-to-day life, right? They don't have any structure. They don't have any structure in their day-to-day life to follow. They don't have any disciplines in their day-to-day life that they follow. Everything is just going with the flow, going based on feelings and emotions that dictates and drives their day-to-day decisions. And that's what's gonna happen in their trading.
Absolutely, it amplifies it. It amplifies
exactly.
it. And
so my advice is the individuals who lack discipline in trading, first start from scratch. Go look at your day-to-day life and see where you lack discipline. Do you get proper sleep and sleep at a good time and wake up at a good time? Are you productive during your day and follow a schedule or a type of to-do list and have some structure with your day? Do you have goals in mind that you follow? Do you take care of yourself mentally, physically, and healthily? Because health-wise, because if you don't, the majority of time, that means your day-to-day life is running on autopilot, zombie mode, and just following emotional, impulsive desires, following the pleasure model of the brain, just trying to fulfill whatever you're feeling. You know what I mean?
100%.
Which will never accomplish anything, just following feelings like that.
Yeah, it will only accomplish short-term satisfaction. And
exactly.
Then it will not lead to the results that everybody's looking for. But yeah, because I feel a lot of people get addicted to the fact that they're, especially with scalpers, because I feel like they get lost in the time frames, you know, and they end up like taking 6-7 trades and they didn't even realize it, and they're trying to give it one more chance, one more push, one more, and then all of a sudden it's out of the plan and they've just over risked or over leveraged or whatever, and everything went downhill from there, because you could be following the plan for so long and then one bad day out of discipline and you just completely ruin the progress.
But that is the true nature of the beast of the market. It's a very sensitive game. I know guys who were extremely good traders, and this is going back to talking about the impact of your day-to-day emotions on your trading life. I knew this individual, older individual in his late 40s, very well experienced trader and investor, made hundreds of thousands of dollars through his years of trading, right? And consistent full-time trader. In his real life, in a specific year, he went through a divorce, lost his house, lost his kids and seeing his kids, and his wife took off. That real world event had such negative impact on his psyche, his emotions, his decisions, that he started drinking, he started doing drugs and so forth. And then he started trading in this psychological state and wiped out years worth of gains in his account in a matter of a week and a month. So at the end of the day, all I'm trying to say is this is the game we choose to be a part of. This is the nature of the beast. This is how sensitive the game of trading is. But this is the beauty of it as well. You also do have the opportunity to make copious amounts of money if you have that discipline and control that's most likely not going to be found at a regular job. But these are the differences. At a regular job, you have stability, you have consistency, you have structure, you have rules and orders that you're following, a hierarchy of leadership that you have to listen to your manager, listen to your director, listen to your supervisor. You have systems in place of how you get paid every single week, that you only get paid for your time rather than your skill. And that can only take you so far and has its goods and bads. In trading, there's a lot more freedom There's a lot more opportunity to make a lot more money, but all of the structure, all of the rules, all of the discipline, all of the hierarchy of power has to be within you. You have to make all those decisions. You have to keep yourself emotionally controlled. You have to keep yourself mentally stable and in a good mental condition to actually be trading these vicious, ruthless financial markets. But you do have an opportunity to make an extremely large amount of money, but you also have an equal opportunity to lose a lot of money. But this is the nature of the beast. The market wouldn't exist if there wasn't more losers than winners. It's just money moving from hand to hand. It's human greed created this. Human psychology created this vicious machine. And if you choose to be a part of it, you can either learn how the game and machine works and prosper, or get lost in the ocean, get swallowed up by the whales and eaten by the sharks. You know what I mean? It's one or the other.
Oh no, absolutely. I agree with you 100%. Right? I think this was a good reminder for everyone to put themselves in check.
Everything has their goods and bads.
Absolutely. And the good thing is the advantages here are pretty high. But as you said, this is a game where the probability is, or it's designed in a way for you to lose because of the human psychology and the greed behind 100%. It. You just have to have a plan around it, stay disciplined to the plan, even though sometimes, because I'll find with some people, they'll pick one example where it went out of plan and it worked, and they'll use it to completely ruin the account, you know? And just follow the plan, follow the long term. When you come full circle with your trading plan, what will you end up in net profit, or will you end up in net loss? And stay disciplined, most importantly. I've been through this over 1,000 times. I've been through the losses, I've been through the wins, and I still go through the losses sometimes. Of course. And it's inevitable. I had personally a losing week last week, but it's inevitable. It happens. It keeps on happening. But at the end of the day, I know, because the system and the trading plan that I have developed, when I come full circle, it will be in profit again. You know,
and to add on what you said before, like these recent times we're experiencing, when we understand the fundamentals, sometimes we can make the decision to not trade certain days. Because now what we're seeing, just before we wind down, market liquidity is starting to drop. This is why you're seeing such volatile movements, very aggressive, lower time frame pullbacks, whipsaws. Equities will bounce up 500 points, then dump again for the rest of the day. Gold will have very aggressive movement on the lower time frame. It's because the market volatility is still there and will always be there with the amount of market participants and algorithmic system trading going on. But market volume and liquidity starting to die down as majority of whales, majority of market makers, 1%ers, whatever you want to call them, they're liquidating out of the markets due to this fear stage of the aggressive rate hike cycles to come. I'll send you a picture after you can share with your group. I sent it in the free Telegram analysis channel about seeing major downflow in liquidity and major outflow of asset classes too. So this is what's causing.
On assets, and you have the monthly global liquidity. Yeah, here we go.
Right, you can see it's dying.
Here we go. You're talking about this.
Yeah, so this is a monthly global liquidity cycle. You can see during the pandemic, the years are down at the bottom. During the pandemic, market was filled with liquidity, right? Yeah. Everybody was jumping in stocks, different asset classes. But now going into 2022, we're starting to have an aggressive drop in liquidity. And if you check that other picture, it shows the worst time to own assets, as we're seeing major outflow out of asset classes, like oil's turning a bit more bearish in the short term. Gold is having its bear cycle. Stock market's having its bear cycle. It's not just that we're seeing short orders and sells enter these asset classes. It's also we're seeing the buyers liquidating out and holding cash on the side or dollar on the side. You know what I mean?
Yeah.
So this is dropping the market liquidity, causing a lot more volatile movement.
Yes, we're seeing it. This is very relatable to the price action we've been seeing. For example, when you guys are trading New York or whatever, you'll see it spike for like an hour and then it's dead. You know? Yeah, and then it just ranges, or it's just choppy, or you'll see
the lower time frames, more aggressive movement, right? So
100%.
Exactly.
Absolutely. No, but Thank you, man. Thank you for all your insight. This was perfect. This was actually exactly the topics that I wanted to cover for today. Most important fundamentals we have moving forward. So, and I hope you guys like, and for the people that are watching later, to take notes so you can guys actually know how to plan your trades, know how to plan, understand the current fundamentals. So that is perfectly what I wanted to cover, and also a really nice movie style booster at the end, reminding everyone to stick to their plan. And
good discussions, very good discussions.
Absolutely. Thank you again, man, for joining. It's always great when we have you here, always insightful. We wish also to continue these collaborations, and thank you again, man. If anyone has anything to say, just send it through, but I think we're good to go. Yeah.
Tell me when you upload it on YouTube. I'll share the link around as well.
Absolutely. Right. Thank you again. Thank you for everyone for joining.
Take care, everybody. Have a great day.
You too.